Other ways of reducing your exposure to taxation is by paying your company income tax early. So if you are a medium scale company and you pay your income tax within 90 days of the end of your financial year, you'll be entitled to 2% discount on the amount paid. And if you are a large scale organization, you'll be entitled to 1% discount on the amount paid, provided you pay within 90 days of the end of your financial accounting year, or 3 months, within 3 months of the end of your accounting year. Then you can also, if you make donations to specific organizations, specific charities, those donations are tax deductible, so they will be deducted before the income tax calculation is done. So such organization includes Christian Organization of Nigeria, the Islamic Education Fund, the Red Cross, the Boys Brigade, the Institute of Chartered Accountants of Nigeria. Those companies are in the Schedule 5 of the Company Income Act. Then when processing your monthly value added tax for payment, you are to net off your tax input. You are to net off your tax input from your tax output. So your tax on your VAT input, you net off your VAT input from your VAT output. That is, subtract the VAT you paid on your purchases from the VAT that you charged your customer on the sales. Then it's the net that you are going to pay to the tax authority. So what we're saying is that, for example, if your VAT on your sales is 5 million naira at the end of the month, whereas your VAT on your purchases was 1.5 million. So what you do is you subtract the 1.5 million from the 5 million to get 3.5 million. So it's that 3.5 million that you are going to pay the VAT on. And note that VAT is on goods and services that are paid for. So it is when your customer has paid for VAT that you're going to pay. You're going to remit those VATs, the net of those VATs, to the tax authority, not on your credit sales. Because if you do for your credit sales, at the end of the day, if the sale becomes bad debt, then you'll be looking for how to get refund from the tax authority, and that usually proves difficult, and it's actually tacky. Then you should also reinvest the proceeds of fixed assets on the same class of asset. So when you sell a fixed asset, for example, say a building, the proceeds from such sales should be reinvested in another building. If you reinvest it in another building, because the class of assets is the same, and as long as the reinvestment is within a year, the capital gain tax derivable from that sale the taxation on it will be postponed till the sale of the new assets. So what we're saying is that if you, for example, if you sell a building for 100 million and you made a profit of say 30 million, and you're supposed to pay capital gain tax of say 3 million on the asset, if the sales proceed of 100 million is reinvented in purchase or construction of another building,